In this case study, we are going to look at a 60-year-old individual with a lump sum of money looking to transfer funds that he has to a cash value life insurance policy. Now, how this individual was attracted to dividend paying whole life insurance is he saw a dividend rate on paper that looked great. Dividend rate, say it is 6%. From a particular insurance company, maybe it's 5%, whatever the dividend rate is. And today, 2021, we see CDs paying what? 1% maybe? What does your checking, savings, or money market pay? 1% at best if it's a premier account. We've seen some a little bit higher, but rates continue to be pushed down. So if I see a dividend rate on paper of 5% or 6%, that can be very attractive. And in this particular case, this individual has a lump sum of $1 million. Says, okay, I've got $1 million that I would like to move into a cash value life insurance policy because I see, Steve, that the dividend rate is 6%. So that means in 1 year, I should earn $60,000, 6% of the $1 million, and I can have it reinvested into my product and just continue to compound. Should be great, correct? The thing is, when we look at a life insurance policy, there's a couple things to be aware of. In this case study, we're going to specifically go over a lump sum study, meaning what's the most efficient strategy to move that lump sum of $1 million into a life insurance policy. And the misconception sometimes, just due to misinformation, is if I have a dividend rate of 6%, that's what I'm earning. The thing is, I want to look at my net internal rate of return, which is what the policy is actually growing by after the cost of insurance, after the mortality charges, after the insurance expenses, all that good stuff. What's the policy actually growing by? So the net IRR, or internal rate of return, will disclose that. We can see the actual growth over time. The other thing to be aware of is with a cash value life insurance policy, going to the basics here, right? We've got our policy design. Money can go towards these two areas, the premium component or the PUA component. Now, in conjunction with the MEC laws, we've got a MEC limit on a policy. If I wanted to pay $1 million into a policy in one shot, not pay anything, not a penny thereafter, and just let it sit and grow, what would happen is I would need a MEC limit of what? At least $1 million, which for a 60-year-old male, with the present MEC limits before the update takes place, it's going to be about $14 million, a little bit more, in life insurance coverage. Now, we can customize the premium. So we actually, in this particular example, just with a $1 million lump sum, you can be more creative than just a basic 1090 split. We're able to get the base premium down to about $80K, so about 8% of the total $1 million. That means the other 920 grand, there's a term rider attached, but the other 920 grand is going towards PUAs, accelerating the cash value growth. A non-MEC, by the way, because you're going to see this, we're going to pull up the example, one-time lump sum, hey, boom, got it in all in one shot, should look great. You would think, hey, if I just pay money in and I'm earning a 6% dividend, look at the guaranteed rate of 4%, we're going to look at that too, it should look beautiful, correct? It won't. And here's the reason why. That premium on a life insurance policy, whether it's $80,000, $8,000, whatever it might be, in order for the policy not to MEC, this is important here, if you're taking notes or considering doing this, in order for the policy not to MEC, must remain intact, that base premium, for a minimum of 7 years. If we chop the premium off, if we execute a reduced paid up, if we reduce the term insurance rider, if we reduce the base premium during the first 7 years, in most cases, if you fund it up to the MEC limit in year 1, you'll trigger a modified endowment contract, which ruins the plan. So what this means is that that base premium, if I'm not paying it, if I just make a one-time lump sum, years 2 through 7, I am relying on the policy to pay for that premium internally, pay for it on its own through dividends and interest. I can execute what is called a reduced paid up option, which chops the premium off. That way it's not existent anymore, and now all of my dividends and interest can be kicked back to cash value. But while that premium is due, if I'm not paying it as the policyholder, that's drag on my policy. It's going to slow things down. And it's important to look at both the dividend rate and the guaranteed rate. So in the particular example we're going to look at here, the dividend rate is not 6%. It's actually 5.65%. And we're also going to look at the guaranteed rate of 4%. This way we can see a current assumptions scenario and also a guaranteed assumptions scenario. Now, I'll let you know, and the numbers will speak for themselves. The one-time lump sum does not look that good. So what we're going to show is as follows. Let's give ourselves some space here. There we go. Is this lump sum payment made in 1 year? So one-time payment, 1 million, broken up into 3 payments, which would be about $333,000, and then broken up into 5 payments, which would be $200,000 per year. So same $1 million out of pocket going into the policy. We just want to know from a guaranteed and non-guaranteed standpoint, what is the best way to move a lump sum of money into a life insurance policy for someone older? Because what often we hear in these situations, if you're 60, let me know if you've ever felt like this, or ask yourself this question. Hey, I love the idea that I see here with cash value life insurance, safe, liquid, tax-free area to position money. My goals, there we go, place I can position funds, acquire real estate. Maybe I'm still actively investing in real estate, transfer assets from a 401k or other taxable account, whatever I'm looking to do into this policy. Maybe it's just money in the bank. And then estate planning as well. I can leave a death benefit completely income tax-free to my beneficiaries. If I have a large estate, I might want to look at setting up or establishing some type of trust where I can move the life insurance policy there to bypass estate taxes. But if I'm in that position, so I love all the benefits of cash value life insurance, but I feel like, hey, 10 years from now, 5 years from now, I don't want to have to still be paying premiums into this product. I don't want to be on the hook for it. No, like this is my number. I want to get it into a policy and that's it. I love the idea of just writing a check for a one-time payment, be done with it. But if it's not the most efficient strategy, okay, show me the different options so I see what the best option is. I see it up front, don't just hear about it, and then I can select it. Let's see it. So we're going to look at these 3 options. Dividend rates first. So on the left, the example we talked about here, we have a $1 million lump sum non-MEC policy for an age 60 male. This death benefit of $14,250,000 gives you almost a clean $1 million MEC limit. What has a direct relationship to the MEC limit on a life insurance policy? Our age and death benefit. You'll see this on illustrations. You'll see this on the illustration software if you're in the industry or if your agent's showing you it as a client when you're modeling policies. Whatever it might be, this is the MEC limit in this example. Now, we make the payment, $1 million. We've got about $900,000 in cash value right off the bat. This is based off of a dividend rate of 5.65%. Okay. Now, year 2, your outlay out of pocket is 0. Goose egg, nothing. Forever. What's happening to your cash value here? Year 2 goes up by a little less than $10,000. The following year increases by about $2,000. Look what happens year 3 to 4. starts to decrease. Like, what's going on here? Up until year 7, and then it starts to bounce back up. Your out-of-pocket payments have been zero. Aside from the first year where we deposited $1 million, what's going on here? Because if I'm earning a 5.65% dividend or a guaranteed rate of 4%, I would think, hey, that's interest earned. I should be appreciating, not depreciating. The reason why, this guy here, so this base premium and a term insurance rider that we don't have reflected in this example is still due. Year 2, that $80,500 plus the term insurance rider is still due. I'm not paying it at all in this example. So what happens is the policy will pull from the cash value, the dividends and interest, or a loan, whatever we elect to do, to pay that premium. That happens until year 7, where we execute this reduced paid up option. If I could write sideways here, what this does is eliminate the premium altogether. The earliest we can execute that is year 8. If we execute it earlier, we'll trigger a modified endowment contract. So another name for the MEC limit is the 7-pay premium test. So what's important to be aware of here is that it's really the first 7 years of a life insurance policy where those vice grips from the IRS are very tight in life insurance policies. And if we manipulate that death benefit, especially decrease it, and we fund it up to the MEC limit on any of those first 7 years, we can trigger a taxable event. No, that can be technical. The simple version is we can't reduce that within the first 7 years, so it has to pay for itself. So why it's decreasing is that the expenses are exceeding the interest earned on the policy. Until we eliminate it altogether, then it rebounds, but I recapture my money 11 to 12 years down the road, based off of the present dividend, assuming that holds forever. Now, let's look at the same $1 million going into the policy, but broken up over 3 equal payments. Break-even point, year 4, for a 60-year-old male. Keep that in mind. We're not 30 here. Does age really matter? Not if a policy is designed right. Years 4 through 7, premium is still due. Again, I'm not paying it. My clean out of pocket was $1 million. Cash value continues to grow. Meaning, funding the policy, spreading it out over 3 years, funds the minimum premium long enough where we've got enough dividends and interest kicking off to easily satisfy that premium and see some growth. We're going to look at the guarantees next actually as well. Then we've got breaking it up over 5 years. Break-even point. Same thing, year 4. Paying in $200,000 per year. By year 4, I've paid in a total of $800,000. I have $802,000. Base premium. You'll notice the base premium on these two, 3 years and 5 years, just over 9%. So this is with an insurance carrier that will allow you to 10x your base premium into PUAs. So the total net payment is 11x my base premium. All companies are a little different there, but we juiced this one as much as we can. This guy, beginning year 6, after we've got the full funding in, if we compare the two, the 5 compared to the 3, which one has greater cash value? Year 20, 3 pay, 1.75. 5 pay, 1.768. Small difference. Now, keep that in mind when we look at the guarantees, because that difference will not be so slight anymore. I am in favor of this design, mainly because if dividends come down, shooting it more conservative, you'll still see favorable performance. Before we do that though, that IRR we talked about, because you get this dividend rate of 5.65%, what am I actually earning? Let's take a look here. So we're gonna pull our formula up here and have some fun. So this is an annual internal rate of return formula, meaning it's going to display what I'm earning each year, not the average over a period of time. One thing you'll notice after we go reduced paid up, all are very, very similar. Because again, it's an annual internal rate of return. But what do we notice with the one pay, year one, about a 10% hit, then I get a little bit of juice, then the expenses outweigh everything, and when I go RPU, I see that particular year from 852 to 885, grew by 3.86%, tax-free. However, the average does not cross over until year 12. Over here, this is what we like to see, strong policy design. Okay. Overall though, I mean, again, we ran these conservative, no indexing, nothing like that. 3.5 to 3.8% for a safe, liquid, tax-free area to position money. We've got the death benefit as well, kind of just showing transparently what it is from a growth standpoint. That's how these products work. Rather than try and say, look at this nice shiny dividend. We want to know it up front. Just show me how it is. All right. Let's look at the guarantees. This is where it gets interesting here. Look at the $1 million lump sum example. What happens to your cash value? This is the kind of stuff no one really shows. No one wants to see it. I pay $1 million in, and really unless I die in the first 7 years, and have that $14 million payout, this example does not make sense at all. So even with a guaranteed rate of 4%, the insurance expenses exceed that earnings rate. That's why my cash value just plummets over time. And as far as when I catch up or break even, we go reduced paid up as early as possible, the answer is never. Never exceeds more than $750,000. Not a good option. If we continue to pay that premium, then it could look a little bit better, but still will not be attractive. This guy. So here's why I mentioned I'm a fan of the 5-pay option. And if you're in a situation like this and you'd like to see samples, regardless of age, let us know. I will state that the older we are, the more sense it makes to spread it out a little bit. And if you say, well, what do I do with, if I pay 200 grand in, what do I do with the other 800 grand I have sitting in cash right now? If that's your position, or you want it out of the other account, there are options. Some insurance companies provide prepaid accounts and such, or maybe we still want to just keep control of the funds in a high yield money market or something like that. Different individuals we work with have different preferences, but there are options as far as where we could put the money if we're in that type of position. But look at the guarantees here. So absolute worst case scenario, crossing over year 7 with the 5-pay for a 60-year-old. Keep that in mind. When we hear, am I too old for this? Compared to the 3-pay, this is where it gets interesting, 10 years. Do you remember that 20-year difference with the non-guaranteed dividend? It's about $20,000 or so. What do we see here? In the 3-pay, 1.28. Over here, 1.38. About a $100,000 difference. A little bit more in the death benefit as well, closer to 150. So this is the kind of stuff that's good to see up front, rather than just say, hey, based off the non-guarantees, this is more attractive and it pays me close to double the commission. So, hey, that's great. Got to be careful with that, and not to say double the commission is the motivator, but if we see the dividend side by side looking great, that's where people can be attracted and say, hey, this option works and I get paid more, it's a win-win. That goes through everyone's head. It's gone through my head in the industry. However, the pitfall, not pitfall, but trap we want to avoid, this is very important, is to say, okay, if dividend rates come down, which they have really since the 1980s, and in speaking with insurance companies, they don't forecast them coming up over the next 10 years. I don't think it'll be the guarantees, but play it conservative. That way, set expectations right, consumers happy. If they don't buy based off the conservative numbers, that's okay. You still were completely transparent with them. Point is, answer questions that would come up or that you would ask if you were just shopping it online, if that were possible. So let's look at the IRRs here. Okay. Interesting how that one works. So we don't need to go over that lump sum, just eating itself alive until we kill the insurance expenses. So let's look at the 5-pay. I mean, in this particular example, for a 60-year-old, it makes sense. If we were younger, you could condense to 3 to 4 years. But annual IRR starts to go positive here, meaning I paid $200,000 year 5 and I get $200,000 back and some, and a little bit more. That's why I see a positive IRR on year 5. Year 6 and 7, the premium is still due. However, my cash value is still appreciating. That means the interest earned based off the guarantee is first satisfying that base premium. You're out of pocket if you're the policyholder is 0. First, it satisfies that premium, then is kicked back into cash value. When we go RPU, reduced paid up, death benefit drop, premium gone, cash value good. Better than it was before. So a lot of information here when we think, hey, I got a lump sum of money, life insurance looks like a good idea, let me move it over. Provided the details here, that's the purpose of these case studies, so we can understand it in and out. If you'd like to see any personal case studies, this is what we do as a business or insurance side. We also have a training and coaching business if you're in the industry. But in any event, I do hope that you enjoyed this one. I did a lot, and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.